Hello. Live from New York City, I'm Scott Fowles from Amvest Capital. We're glad you could join us for today's webinar with our team from Amvest Terraden. A special thanks to our partners at Coherra for hosting today's webcast. This webinar is for informational purposes only and does not constitute an offer to sell or the solicitation of an offer to sell or buy any security and should not be relied upon as a basis for investment decisions. Amvest Terraden focuses on companies engaged in exploring, developing, and extracting critical minerals essential for advancing new technologies crucial for the global transition to decarbonization. These technologies span various sectors, such as transportation to energy generation and storage. What sets Terraden apart is our unwavering commitment to ESG compliance. We exclusively support companies operating within the Western value chain, ensuring they are not tied to Chinese or Russian interests. This approach aligns with our dedication to sustainability and responsible resourcing. Joining us today are my colleagues from Amvest Terraden, co-founders Stuart McIver and Tomas Nadrowski. Stuart is also the co-founder and managing partner of Amvest, a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. With a unique blend of finance and geology expertise, he evaluates natural resource opportunities from both the technical and financial angles. Stuart brings extensive experience in corporate advisory and transactions spanning M&A, equity, and debt capital markets in the natural resources sector. His credentials include a Bachelor of Commerce from the University of Western Australia, membership in the Institute of Chartered Accountants in Australia, and a graduate diploma in geology from Western Australian School of Mines. Tomas is the founder of Amvest Terraden and the portfolio manager. He is a seasoned expert in mining and investments with 25 years of experience spanning the globe. His professional journey includes roles as portfolio manager, commodity strategist, commodity analyst at various firms across North America, all the way to London, the Netherlands, and Johannesburg. Tomas is a director of the World Economic Forum, holds a CFA charter, and is fluent in an impressive 7 languages. He earned advanced degrees from the School of Economics and Social Sciences, as well as the University of Geneva. Following today's formal presentation, we will open the floor to questions from our audience. We especially value questions from you, so please submit them in the chat box, and we'll make sure to ask them of our presenters in real time. And so without further ado, I'll turn it over to Stuart and Tomas.
Great, Scott. Thank you very much, and thank you everyone for joining us today. As Scott mentioned, we at Amvest Terraden are experts in mining, but I will disappoint all of those mining fanatics on the call who would expect us to talk about long-hole stoping, cut and fill, room and pillar, the size of a berm on a bench in an open pit. That's not what we're going to do. We're going to zoom out a little bit and focus specifically on the critical minerals sector and try to answer a couple of questions we see on this slide. Finding answers about the critical minerals value chain in general, not just mining. First, there is this divide, which is almost taking political dimensions between being green and being energy secure. And the question is, how can critical materials help us solve that dilemma? The second question is, why actually are we so dependent on Chinese critical minerals, how it happened and what can be done about it, given that weaponization of that rift is very present and took a form that's very threatening in 2023. I'll talk about it a little more later. There's one factor in specifically this mining sector, critical mineral sector, which is quite displeasing for generalists, and that's high volatility. So we'll try to unpack that and just look for reasons of that behavior. All commodities are volatile, but some of them a little bit less than critical minerals. And then finally, we'll look at the reasons to be actually interested in this space as an investor. And we'll look if, what are the best moments in the cycle and how we can actually frame it. There are actually 3 good reasons to look at this space already in 2024. So let me start with quoting a man who until recently was the wealthiest person in the world and who at the somewhat downbeat earnings presentations of our Tesla stated that unless tariffs are imposed on Chinese electric vehicles, they will pretty much demolish other car companies in the world, quote unquote. Now, there is a reason why Tesla is still selling more electric vehicles in the United States than, say, BYD, which is a Chinese company and the largest producer of EVs in the world. And that reason has a lot to do with Trump administration's anti-Chinese tariffs, 27.5% tariffs that were introduced a couple of years back, maintained by Biden administration. If you compare the situation to the European market, Europeans have only 11% tariff on Chinese cars. What does it mean? It means that if a European consumer wants to purchase say, an electric vehicle such as Audi, a German brand, for 45,000 euro, and then has an option to purchase a brandless Chinese equivalent at 15,000 euro, then an 11% tariff is not going to help to protect the German maker. So very possibly it's going to be Dongfeng or Chang'an rather than Volkswagen, Stellantis, Hyundai, Honda, Ford, General Motors, you name it. So the question is, is this protectionism the answer? And my kind of gut reaction is, well, for a while it may be, but it's not like the other side cannot retaliate. And so this is kind of the first step towards understanding whether we can pull off the green transition using critical minerals without losing economic security, without, for example, destroying the car making industry in the process. Some 18 months ago, the Biden administration introduced Inflation Reduction Act, probably the most significant piece of legislation passed by this administration and previous Congress, actually, in addition to maybe the CHIP and Science Act. But the IRA is expensive. At the time of its passing, it was considered to cost about $385 billion. But by the end of last year, these estimates shifted to about between $1 trillion and even $3 trillion by the time these policies will be fully executed in a couple of years from now. That is quite disappointing. These policies are expensive. Not only are they expensive, they don't necessarily really promote very well the transition. We only had full clarity over the impact of IRA on credits, federal credits for electric cars towards the end of last year. And we found out that only 7 different models of electric vehicles qualify for the full $7,500 federal tax windfall. 7. Do you know how many electric vehicles there are in the world running on critical minerals? How many models are there? 500. 500. Out of those, only 7 are available to the economically minded US consumers. So the world's largest consumer, with some constraints on its pocket, will look at only 7 vehicles. That's 1.4% of the global range of electric vehicles. So there's been a reaction from the left side of the political spectrum, and I would call it kind of a binary reaction. The reaction is, well, you know what? It's too expensive to pursue decarbonization without China. The more extreme view is that it's simply impossible to pursue new electrification without China. So that's the left view. On the right side of the political divide, you have that view that, well, we already lost. It doesn't make any sense. This is too expensive. Let's just, drill, baby, drill. The problem with this, that what works as a political sloganeering doesn't really work for an investor. So on this chart, you can just compare the periods where drill, baby, drill was the real policy adopted by Trump administration last time. That's the blue chart, the blue line here, and that shows the performance of traditional energy stocks, oil and gas stocks. Boosting volumes is never particularly good for margins. And so which administration has been the best for traditional energy? It's the Biden administration, is the squiggle on top. So we should dissociate what we hear in politics from the investment opportunity. We recently visited a well-known lobbyist in Washington. He said that he's not interested in knowing whether it's right-wing or if it's a left-wing. He just wants the full chicken. And actually at Terraden, so do we. So we have to first find understanding why we are in this situation. Why is China so far ahead? And the very simple answer to this is that while we in the West have benefited from technological breakthroughs in terms of these new processes that allow us to adjust different mined metals to feed into new energy solutions, whether it's in wind power, whether it's in storage, whether it's in transportation, we did it because of the green transition. That's not how China looked at this problem. China looked at new electrification as a road to energy security. Now, what does it mean for China to be insecure? Well, China is not a very significant oil producer. It's the world's largest importer of oil, and it imports most of this oil from overseas, from the Middle East, and from Russia. We have moved into an era of strategic rivalry, and there's been always a view that China is so deficient in energy resources that being dependent on maritime flows of shipments of especially crude oil, it would be quite possible for its rivals, say American Navy, to close off the space around the Malacca Strait. That's the Malacca Strait trap, the dilemma for the Chinese leaders. What happens if a kinetic conflict breaks out and suddenly the routes for oil shipments, or LNG shipments for that matter, are blocked by the US Navy? And of course, the Chinese have been looking at that as well. That's the reality of geography and geopolitics. And they started looking at solutions. Critical minerals are part of this solution, but it's not the only one. They're actually part of a four-pronged policy that China has deployed, starting with things that are maybe not of immediate interest to us here, such as large stockpiles of not only critical minerals, but also oil and gas, especially oil. I think China stockpiles about 50% more than International Energy Agency advises to stockpile in times of peace. It has uranium stockpiles at its utilities for 10 years, which is 5 times more than, say, Europe or United States. And of course, stockpiles food and other commodities as well. Its second pillar of its policy is the no limits partnership with Vladimir Putin. Today, it's Russia that's the largest exporter of oil to China, no longer Saudi Arabia. That switched in sometime last year, 2023. And China has been banking on alternative routes for those shipments, importing, for example, most of its natural gas overland from Turkmenistan, and maybe in future also from Russia via the Arctic route, not via Malacca Strait. Third pillar, and that's the one that really is most interesting to us, is the reliance on domestic sources of energy, of which China is well endowed, although it doesn't happen to be oil and gas. It happens to be coal. China has been adding between 180 gigawatt hour of new coal power energy generation per annum, basically building in 2 years what the United States has in total. In addition to that, is also building up solar power, additional 213 gigawatts last year. That's more than all of the installation here in the United States, built just in 1 year. Why do they do this? And why does it matter for critical minerals? Well, let's take transportation. Vehicles are built with critical minerals, or batteries based on critical minerals, run on the grid, on the local electricity grid. If the grid is 70% dependent on coal, as is the case in China, then the cars run on coal, or at least 70% of what they run on is coal. And this is not a policy that's unknown. Actually, I worked in South Africa many years ago. Apartheid era South Africa had a similar scheme during the time of the voluntary oil embargo against South Africa. And its company Sasol was using coal, transforming it to liquefied fuels in Mpumalanga. It used to be Transvaal. It's called Fischer-Tropsch process. And it was also done for reasons of national security. And China has approached this with a gusto, looking at the entire value chain, which we'll see in a moment, from critical minerals to transportation, developing inorganic chemistry, mineral refining, mineral separation, building precursors for cathodes, anodes, separators, electrolytes, battery production, of course, and electric vehicle production. So much so that the country has built up overcapacity, twice as much capacity in electric vehicles as the domestic market could potentially stomach, 4 times as much capacity of the battery making that would be necessary for just the domestic market. The result is that today China controls most of the midstream in this market, 70% of lithium refining, 70% of cobalt refining, 45% of nickel refining, 90% of light rare earths processing, and about 100% almost of heavy rare earths processing, separation, and refining. How do we know this? Well, we know this from statistics. And statistics show that China is moving very fast away from ICE cars, internal combustion engines. This chart shows that actually last year, for the first time in history, the number of ICE cars in China declined for the first time. Right now, more than 50% of vehicles in China are already electric. That actually means that the peak in gasoline demand is coming very close, and probably we'll see a gasoline demand destruction as early in 2027. So it is kind of important to look at it from the perspective of, is this just protection? Is China only protecting itself, saying, as you see in this slide, 再见燃油车, goodbye gasoline cars? Well, as in every battle, there is always a shield and a sword. And so far, I presented the Chinese shield. The sword was formulated about 3 years ago, but over 3 years ago in the China export control law, which was applied last year in 23 on a number of occasions, affecting critical minerals industry. First, China banned exports of rare earth separation technology. Actually, there were 2 announcements related to that, which is interesting because this skill set is very scarce in the West, given the abandonment of that value chain some 25 years ago, also by the United States. Then somewhere halfway through the year, China banned exports of gallium and germanium, 2 minor metals important for infrared vision, some low melting alloys, 5G installations in case of gallium, and so on. And then in November, China banned exports of natural graphite, which is a critical component of anode production for battery making. Indeed, some 51% of the weight of your battery comes from graphite. And right now, the West is pretty badly deprived of anode building capacity. So how can we actually respond to this? Well, first, the West has started responding. And when I say the West, I don't mean cultural West, I mean functional West. What is functional West? It's cultural West, North America, Australia, Europe, as well as countries in Northeast Asia, such as Japan, South Korea, and Taiwan, whose systems are based on the German civil law. That's what we call functional West, and that's what we see in the division of value chains, which are of strategic importance, such as semiconductors and not least battery making that we're discussing here. So the West first looked at the car making, of course, one of the last remaining industrial sectors that are still vibrant, or were vibrant until recently in the functional West. What's the closest node in the value chain to car making? Well, it's the battery production, the cell production and pack. So much so that Western investors, including Japanese and Korean investors, deployed about $330 billion in commitments to build those factories to build batteries. But what's the point of having all those factories if you cannot find material, chemicals, domestically or among like-minded countries of the functional West, because they don't produce enough of lithium hydroxide, lithium carbonate, nickel sulfate, cobalt sulfate, vanadium pentoxide, coated spherical graphite, niobium pentoxide, high-purity manganese sulfide, or high-purity phosphorus pentoxide. All of these are left to that large node from gigafactories. And of course, to produce these chemicals, you have to mine them. So there's this probably a more optimistic element, is that mining could be redeveloped to a much larger extent to serve our side, the Western side of the value chain. Why? Well, because of the history. Because some 200, 250, 300 years ago, some plucky Brits, some audacious French, some wily Portuguese, and some very bold Spaniards colonized vast swaths of the New World, North and South America, and Oceania. Colonize, I mean colonize and stayed there. And so very geologically prospective regions are today open to Western technology and Western capital. Regions such as Quebec, Ontario, Western Australia, Minas Gerais or Bahia in Brazil, Catamarca, Jujuy, or Salta in Argentina, and several others. Most of the mining industry in the world is located and listed in Canada and Australia, some 70% of them. In Canada and Australia, about hundreds of companies that focus on critical minerals. They're also usually congregate around these two markets. So it's possible to redevelop these markets if Western capital is directed towards them. Unfortunately, as recently as yesterday, we saw a chart comparing the size of limited partners involved in mining specific funds in UK and in Canada in 2023 compared to 2010. And it's a drop of about 75%. Western capital simply is not going into mining, not sufficiently to restart this value chain upstream. One of the reasons for that is the volatility, the embedded volatility of this market. You might have heard about the booming electrification and decarbonization for the better part of the last 2 years. And the truth is, during those last 2 years, the prices of critical minerals have been falling. Really, in the last maybe 20 of the last 24 months have been falling. So much so that we can expect maybe very soon to have some cover from the economies that's usually very counter-cyclical, telling us that it's over, that it's finished. That basically it's finished. Well, it's certainly less sexy. It's less sexy because the adoption curve has moved away from its most vertical section towards a more kind of diagonal section. Volumetrically, however, it means that critical minerals are more demanded today than they were 1 or 2 years ago. So it's important to keep it in mind that being less sexy doesn't necessarily mean dead. And if you don't believe me, just think about Brigitte Bardot. So let's talk about this volatility and where it's coming from. You have to, these two charts are of two different lithium chemicals. One on the left is lithium carbonate, and one on the right is lithium hydroxide. They are used for different chemistries of battery production. And if you see, of course, the big upswing in 21 up to beginning of 22, and then the dramatic slide over the next 2 years. Now, why is this happening? Picture an Australian lithium mining company. An Australian lithium mining company will produce a concentrate. So we'll dig something and concentrate it into somewhere between 5.5, 6% lithium concentrate, which it will sell to a converter. But the converter, most of the time, is not in Australia, it's in China. And Chinese converters exhibit a very pro-cyclical behavior, which is typical of a lot of non-consolidated value chains in China. As you know from your shopping, Chinese producers are good at one thing, cutting costs and selling things cheaply. So what happens when those prices of lithium fall? What does the converter do? The converter is going to play a survival game. Since the space is very fragmented, this is his or her opportunity to consolidate the space, to survive in this low price environment. By doing what? By churning as much material as possible, regardless of the price. So it's the survival of the fittest at the low level, competing mostly on cost and hoping to be the winner in a market consolidation game. So it's a fight for market share. It's very procyclical because at the same time, by churning out all of this material, the signal that's sent to the market is that there is glut. You don't need it. And of course, we're overshooting on the downside. Then when the market picks up, and I'll tell you in a moment why it would, when the market picks up, the same converter exhibits the opposite behavior. Seeing the price going up, the Chinese converter will withdraw the product from the market, hoping for higher margins to be clinched later on. And therefore, again, sends a wrong signal to the market, a signal of scarcity, which is a bit artificial past a certain point, right? So the market overshoots on the downside, the market overshoots on the upside. In this situation, you see on these charts, what could lead to a final rebound? Well, there are only two ways in any commodity space, especially mined commodity. The first one is that this destocking that started somewhere in the middle of the value chain, for example, too many batteries, eventually runs its course. So the car makers will demand more batteries. Batteries will need more anodes and cathodes and electrolyte and separators, which will need more precursors, which will need more refined chemicals, which eventually will ask miners to mine more. And so this is the normal cycle. A more dramatic case is when this downside lasts longer. And then the miners, which are the most capital intensive of all those different nodes in the value chain, suffer most. And what happens when they suffer low prices? Well, first they will start to put on hold their brownfields exploration plans. Then they will delay some expansion. Then they will mothball certain legs of a production, eventually will shut down the mine. When they shut down the mine and the market eventually rebounds, this is exactly the moment where you want to be in the mining cycle, invested in the mining cycle. Because when the price signals come that the market is moving back up, it's reopening a mine is not as easy as swishing through your iPhone. It takes about 12 to 18 months, depending on type of the mine, if there is really a decision to restart the production. And that delay means that you have like a tight string effect, and this is where the commodities really overshoot very strongly. Now, how long are those inventory cycles? Well, that of course depends on the commodity. A lot of commodities like copper are fairly mature. They have well managed liquid markets, futures market. It's possible to hedge copper exposure for financiers, such as a bank that will do project financing for a mining project. And these waves are fairly well known. It's about 5 years up, 5 years down, with a little bit of intra volatility between those waves as well. Now, in those more immature markets, because we're talking about critical minerals that really took off only really for real around the beginning of COVID, but the market existed before in smaller volumes. And here on this chart, you see the prices of a popular ETF called REMX, which shadows an index for rare earths and strategic metals. And so what you see is that in these minerals, those waves are much shorter. It's about 2 years up and 2 years down, 2 years up and 2 years down. So when you hear in the media talks about problems at General Motors, problems in Ford, demand flattening out a little bit because we're no longer in the middle of that S adoption curve, take this into account. This could become a really interesting moment to start doing your homework on critical minerals. Which brings me to the question, why should we be interested, giving all this background, why should we be interested in actually investing in this space? And there are 3 ways to answer this. First is the structural shift that's been operating now for about 3.5 years in this market. Secondly, the cyclical opportunity that I already alluded to. And thirdly, what I called a free call option on the bifurcation in the value chain. So let's start with the structural change. Whatever you hear from the downbeat commentary in the upcoming Economist cover, if it ever surfaces, is that this story is behind us. Let's focus on something else. In fact, high-powered, high-capacity batteries are not behind us. They're with us. They're with us for a portion of our transportation, land transportation. They will soon be with us in aircraft building. They may one day even spill over into shipping, at least for those producers who won't have access to nuclear energy. Just to give you an example, giving all those negative headlines about this space, last year, the sales of electric vehicles were up by 35%. 35%. This is not an industry in distress, okay? And if you look at it from the perspective of the embedded power of the batteries, it's about 50% increase because batteries are much larger than they were a year ago or 2 years ago. So if we just compare the last 4 years, say, since this new wave came with the advent of the pandemic and the fast acceleration of electrification in 2021. In 2020, the entire lithium market was only 126 kiloton per annum, and it fed into 180 gigawatt hour of energy embedded in batteries. That was the equivalent of about 3 million vehicles sold in that year. 2020. 3 years later, 2023, it's 14 million vehicles. 14 million vehicles, that representing now the first million ton of lithium and the first terawatt hour of embedded energy in batteries. And going forward, 2030, we will see probably something like 2.4 terawatt hour of energy embedded in those batteries. And that corresponds to about 2.3 million ton of lithium. Roughly 40 million vehicles would be then sold in the market, electric vehicles, which means that most vehicles around the world at the time that will be sold will be electric. It doesn't preclude fossil fuel. I don't believe for a moment that somehow gasoline cars or diesel cars will disappear. That's not going to happen. And I think new technologies will come. Watch Japan working really hard on next generation. But by 2030, these will be still minority solutions. So that's the structural reason. The second reason is the cyclical reason, and this is just the zoom of that previous ETF REMX chart showing the last 2 years. Pretty disappointing. So disappointing that this scenario that I mentioned before of mining companies responding, constraining supply, has begun to unfold in some of these commodities, not least in nickel. Already 230 kilotons of nickel have been taken off the market. I think BHP wrote off, $2.5 billion of its nickel assets. And Indonesian producers, who are actually among the lowest cost producers, even they are announcing the closure of about 100 kilotons. So altogether, that's some 12% of the nickel market. Whether it helps or not, whether the market remains oversupplied, it's a different story. I am not in any way encouraging to invest in nickel right now. This is just to illustrate the point, is that this cyclicality at some point can become an investor's friend. I don't know, Stuart, you want to add something on nickel from the Australian side?
Yeah, so the recent fall in nickel prices has wreaked havoc through Western nickel miners, and all this comes on the back of nickel price decreasing, 50% 2023. And so geologically, there's two sources of nickel, two types of nickel. There's nickel sulfides and nickel laterites. Over the past 10 years, global nickel output has increased by more than 65%. A lot of that has come from nickel laterites, which are mainly in Indonesia and mainly backed by Chinese sovereign wealth. And so this low-cost nickel supply from Indonesian nickel laterite operations has kind of flooded the nickel market. Kind of links into what Thomas was saying earlier about Chinese EV manufacturers flooding the market with low-cost EVs. And so on the sulfide side of nickel, which is typically used in electrification, laterite can also be used in industrial stainless steel operations. So Western Australia is a large source of sulfide nickel globally. Recently, the Australian government classified nickel as a critical mineral in Australia, so this can enable some of the nickel miners to access low-cost government loans. And some of the mining groups in Australia are lobbying the Australian government to introduce some form of tax or mineral royalty relief for the nickel mining companies to avoid a severe layoff of the workforce in that area, in the state and the country. So as Thomas mentioned, BHP, one of the world's largest mining companies, flagged a $2.5 billion cash impairment against its WA nickel assets. And then they're also, questioning the long-term future of their nickel operations in Western Australia. Glencore recently announced that it's planning on halting production in New Caledonia, and it's also searching for a buyer for its 49% stake in another nickel mine it owns in New Caledonia. IGO, which is previously known as Independence Group, announced that they expect their Cosmos Nickel development project to be placed on care and maintenance after spending $90 million in CapEx last quarter. Previously, IGO bought this asset from Western Areas for $1.3 billion back in 2022, and I've just written that off now. Wyloo, which is backed by Australia's wealthiest man, Andrew Forrest, from Fortescue fame, They are planning to place their Kambalda nickel mines onto care and maintenance. Only 6 months ago, Wyloo bought these assets off Mincor for $760 million. Chalice, a very large nickel PGE developer in Western Australia, announced they are having plans to reduce expenditure on its asset due to the market conditions. South32, very large diversified mining company, announced the strategic review of its Cerro Matoso nickel project. First Quantum, who have large nickel operations in Western Australia, announced their Ravensthorpe nickel laterite mines will be placed on care and maintenance. Previously, this mine has also been shut down on care and maintenance in 2008, 2017. Panoramic, another Western Australian nickel mining company, went into voluntary administration, or Chapter 11 as they'd call it in the US, with their Savannah nickel operations being suspended last year. So yeah, tough spot for the nickel sector.
Yeah, there are some ideas also among the managements and the boards of nickel companies how to dissociate this nickel sulfide market in Australia, or say Canada and elsewhere, from the laterites in Indonesia and somewhere else in the Pacific and more tropical areas. And the idea comes from the market itself. Most of the sulfide nickel can go into the class, we call it class 1 nickel, that's easily amenable for production of the sulfate for the batteries, whereas the process of the nickel laterites, while it's not impossible, it's actually environmentally very damaging. So it's kind of self-defeating to use it for something that's supposed to address problems of CO2 emissions. And therefore, there's this push to dissociate the contracts at London Metal Exchange between the class 1 nickel, the clean nickel, and class 2 nickel, and having two prices. But so far, this lobbying has not really helped. Anyway, thanks, Stuart. So, these were the first two reasons why it's important to look at the space structurally, this big structural shift with the energy market being the largest pool of demand for these critical minerals. The second, the cyclicality and the cycle. Whatever we can say, we're not on top of the cycle. we somewhere close to the bottom or at benthic levels. So there's also a third reason. The third reason is the call option. So what do I mean by the call option? So, as I said, this sector is driven essentially by demand from the energy market. This is unusual for mining, at least unusual since the first industrial revolution some 200 years ago, where coal was absolutely critical for the technological development and transportation. And of course, most mining was directed at coal at that time. Since then, most mining focused on metals, whether base metals, precious metals, ferrous metals, and so on. And that predominant means creating something, building a stock. Now, with mining coming back to energy is not a stock, it's a flow. And unfortunately, in every conflict, there are chokeholds that can bar the flows from flowing easily. And that's important when the question of energy security suddenly resumes its forgotten role in economic thinking and board decision-making. Therefore, we believe that it's really quite useful to identify companies that serve the Western market, the functional Western market. Not, you might have in your portfolio Apple, Nvidia, and other companies that will be hugely damaged in the case of deterioration of the international situation, especially in the Western Pacific. And maybe it's good to offset that. If you look at what happened with the rare earths in 2011 when China suddenly slashed the quotas for the exports of rare earths, the prices of these components went through the roof by a multiple of 30 roughly, not 3. And so it's important to keep that in mind, that there is this free option that we cannot really quantify if the portfolio is structured towards the Western side of the divide. So since I'm speaking about the portfolio, let's have a look at what are different ways to think about it, the composition of the portfolio of critical minerals for mining, exploration, and development companies. And there are 4 different ways to build diversification here for different reasons. Number one is, of course, the changing technology. You might hear all the time about new technologies, batteries or permanent magnets or other applications that may affect this or that substitute for another component from a different critical mineral. So it's important to stay on top of this and see the difference also between what is R&D and what is the commercialization at the end of a long process of pilot plants, demonstration, and eventual finding the proper building and investing infrastructure for the new solution. But there is, a dozen of these minerals with different tension between supply and demand, and you can weigh your exposure accordingly. The second area is the jurisdiction. We're going here clockwise. It's important to choose the right jurisdiction. Some are better than others. Just the other day, we were at a Canadian event at the consulate here in New York, and the consul said that Ottawa is looking at fast-tracking permitting for companies active in Canada. It's important because early in the stage of exploration, we are in a long duration security, so we're far away from the cash flow. Permitting is a big chunk of that timeline that takes between 7 and 15 years from the discovery to production. Well, Canada is promising to slash that timeline for permitting by a factor of 5, which would be just astounding. So it's good to look at those areas which are really quite favorable for mining for a number of reasons, including ESG compliance and so on. Another area is, of course, managing the volatility itself. It's possible to be on the short side of certain securities in this market. It's also possible, at least in the North American context, to be active in the equity option space. And eventually also duration. So I mentioned 3 types of companies: exploration, development, and cash flow generating producers, with therefore different duration to their cash flow. And this composition of the portfolio should be adjusted as per where we are, where you believe we will be in the interest rate environment. Are interest rates going up, down, stay where they are? And then just like in any other portfolio, you can adjust duration accordingly. So that's the different ways to deal with the opportunity and with the composition of the portfolio. So just to wrap up, first, I don't disagree entirely with Elon Musk that protection is important, but protection is not sufficient. Capital has to go not only into gigafactories, but also those other nodes in the value chain. And if that really happens and these floodgates start reopening again, then we have good reasons to invest, not only because volumetrically this space keeps growing, because cyclically we have begun to see the first seeds of the next bull market because of the supply response, at least in some of these commodities, and finally because of this free call option on further fracturing of the value of the value chain between China and the functional West. So these are the 3 lessons that I would like you to keep in mind. So that kind of concludes the main part. I don't know, Scott, if you have any questions from the chat room.
Yeah, thank you guys. That was fascinating. And to our audience, please submit any questions you have to the chat, and we'll be able to ask. We actually have one that just came in from Brian. Can and should one trust the Trudeau administration to actually enforce through a speedier and less heavy-duty mining approval process?
I love political
Thoughts on
questions.
that?
Canada has certain advantages here. Certain advantages because it can attract U.S. capital faster than other jurisdictions, partly because it's also open to the Defense Procurement Act and its amendments. Therefore, it's really in the interest of the Canadian government to do this. I mean, you see it both the Quebec and Ontario governments are very actively promoting their connectivity across the border to the south, where still a significant car making production centers are. Therefore, I'm not losing hope for this. Of course, things are complicated. There are certain elements of the Canadian process, the benefit agreements with the local holders, with First Nations. That's something that you cannot cut corners on this. but you certainly can smoothen and streamline the process. The timeline for this, let's hope it's going to happen before the next election in Canada.
Great.
Thanks. I'm also curious, what are the risks
that other battery technologies are developed and potentially undermine investments in critical minerals? Particularly, I'd like to know what you think about, in your opinion, on sodium-ion batteries.
Mm-hmm. Okay, so new technologies are being developed all the time. And that's part of the beauty of this sector. There are certain elements, certain components, certain critical materials we're looking at now we were not looking at 2 or 3 years ago because of new technologies coming. Specifically on sodium, I think there is certainly space for development, certainly for storage, not yet for transportation because of energy density. So energy density in sodium maximum, what I've seen is 160 watt hour per kilogram, which is lower than the Western cars, 200, 220, 230 right now. As I mentioned before, the batteries are growing in the Western market. Could be a little different in the Chinese market, of course. I think China plans about 140 gigawatt long-term plan. I mentioned before that the lithium market is already over 1 million ton. So 1 million terawatts. So it's a tiny component in plans, and I think Western world is a fraction, maybe 10% of what China is planning. I think the problems with sodium will remain is that if you're targeting circular economy and recycling, which is complicated in the case of lithium, there is just simply not enough recycling credits from sodium. So that's one complication. Right now, cyclically speaking, lithium is so cheap that there is no incentive for Northvolt or anybody else to further commercialize their breakthroughs in sodium-ion technology. So, there are other technical issues related to like the cycle times and so on. I'm not going to get into this. It's definitely a work in progress. And believe me, sodium is not going to be the last story in the market. We're going to have magnesium, what I called café, calcium iron batteries. Unfortunately, not with latte, but with sulfur in it. So we'll keep hearing about it. But you also need to amortize the existing infrastructure for what has already been built in. So yes, you have to monitor this, but there's no reason to panic and switch between the critical minerals from one day to another because of some headline in the press.
Yeah, I think I'll just add to that. People shouldn't forget that I think Sony came out or acquired the lithium-ion battery technology in the late 1980s, and that's still widely used battery these days. And we are constantly monitoring different technologies because they'll definitely replace existing ones. The beauty of what we do, for example, we have zero exposure to nickel at the moment. And if there was any new developments with a new mineral, we would certainly add that to the portfolio. Graphite, for example, every end user of graphite has to build a battery specific to one particular graphite mine. So you can't just close, they can't just change their supplier of graphite from one mine to another. They doing years and years of studies on the particular source of graphite. So it's hard for these things to, switch and change.
I have another audience question. Alexei is wondering do you think the lack of IRA qualifying vehicles is more a problem of the IRA itself, or rather the lack of critical mining capacity of IRA compliant countries, of which the IRA will encourage development?
Yeah, great question. It's both. I don't know if you followed this whole debate over something like 18 months from IRA was announced to the final trickle of electric vehicles that are available for that. There was a debate about the so-called foreign entity of concern. Just read China, Russia, Iran, North Korea, but mostly China in our case, plus nickel, in nickel case, Russia. There were those two views actually three views. One was we need electric cars no matter what. The second one was we need electric cars based on just US components. And Joe Manchin represented this originally. And then the third one, which won eventually, is that let's open it up to FTA, foreign trade agreement partners, plus some others. So Japan doesn't have FTA with US, but it was open to this as well. Well, obviously, in recognition of a lack of capacity, mining capacity, refining capacity in the United States, we're only moving now with the last two administrations, let's face it, to reindustrialize United States and our partners and allies after something like 25 years of neglect, not only in this value chain, many others. I mean, look at the deindustrialization charts during the George W. Bush 8 years of presidency and the next administration as well. So yes, that's a kind of a recognition of the status quo. It's very difficult to source everything in America, and many jurisdictions here don't belong to our favorite jurisdiction when it comes to timelines of permitting and mining.
Another question from the audience from John. He's wondering what happens when China forcefully retakes Taiwan. Can the U.S. actually stand up to China to the point of a possible war with the chokehold China has on these minerals?
Okay, so Taiwan is not a key node in this value chain. It's, of course, 85% of advanced semiconductors, just about all of the sub 3 nanometer semiconductors in the world. And therefore, in terms of critical minerals, what goes into that production, TSMC and UMC and so on, ironically comes actually from an American mine, a North Carolina mine that produces the only source of high purity quartz. So strangely, in that value chain, we very well protected for as long as we protect Taiwan. Now, of course, if something were to happen there, I was in Japan not long ago, and obviously it's not going to involve only the United States, because that value chain, the semiconductor value chain, is very strongly integrated with Japan, with the Netherlands, with design from the United States and Taiwan. But it's not predominantly a critical minerals issue. The problem for Taiwan in case of, say, quarantine and so on is, of course, access energy supplies. This is not Ukraine. It doesn't have a border with Poland. It's not so easy to resupply it. And anybody's guess what's going to happen to the semiconductor industry. I mean, I think Rand published a paper a couple of months ago showing that it will send us back technologically some 20 years. All right, so goodbye AI. If it were to happen, let's hope it won't. But as I mentioned, there are ways to build your portfolio to steel yourself a little bit to this scenario, which I hope will never happen.
What
are the emerging minerals
that may not have been targeted 3 to 4 years ago, but are having growth now?
So I have my favorite. Maybe Stuart, you have yours. My favorite would be niobium. Niobium used to be controlled by just a very large private Brazilian company with some equity input from Korea and Japan. Formerly a South African/British company that sold its asset in Brazil to a Chinese player, and a Canadian gold niobium company that sold it to a private player at a wrong time. So very consolidated with supply, which is so concentrated in basically 3 hands. This material couldn't really pick up in terms of its application. And the applications are interesting, mostly on the side of the anode. Toshiba has been working on it for a long time, developing niobium titanate oxide, which would make charging a question of a couple of seconds. But just there is not enough niobium to develop a global infrastructure for this new form of anodes. However, that's the reason precisely why you should be interested in identifying good peralkaline or carbonatite deposits in usually associated with tantalum, sometimes with rare earths in certain places. And we realized that the graphite problem that Stuart alluded to and why I mentioned with the ban on Chinese exports will eventually lead to some changes with technology on the anode side, and niobium is on the pole position there, with maybe silicon as well. It's pretty good specific capacity. Stuart, do you have yours?
Yeah, I'd add to that a new source of, or not new, but a more popular source of rare earths being in the clay, hosted in the clays, and whereas historically, say in Western Australia, it's been a carbonatite geological origin of the rare earths. So Brazil has seen a huge increase in their prospectivity for, rare earths hosted in clay style deposits. And I think separate to that, there'll be interest in other materials that will make everyday items, including vehicles, lighter and stronger. There's a company that's got a new process for producing titanium oxide powders, much cheaper than the historical Kroll method for producing titanium. So that could see an increase in titanium used in, vehicles, planes, other sorts of materials that can make these vehicles and operations more efficient and lighter.
Great, thanks. As we start to wrap up, I'm curious as the sector experience volatility yet remains pivotal for energy transition, what advice would you give to investors looking to navigate the critical minerals market, particularly at this point in the market cycle? I'd like to hear from both of you.
So unfortunately, there's no magic wand here. It's a complex place, very complex. Not only mining, but also metallurgy, which usually kills projects faster than geology. You have to rely on experts. You have to rely on people who know it, who touch it, who travel to the mines, who see the circuits. That's probably the only way to do this. Dabbling on it on your own, it's a little bit like with bioengineering. How much expertise can you develop on the side as a hobby? I don't know. So there is no magic wand. Just I see one question about copper. Of course, copper often is also included in the group of critical minerals. We actually have bracketed out. It's a much more mature market. The reason why is that we just don't have sufficient information statistically what the deceleration in the building of Chinese infrastructure and real estate will represent for drop in the copper demand, and whether global electrification represents volumes that can replace that. Let's not forget that China is undergoing a very significant economic crisis, and much of its built-up was very, very extensive and very copper hungry. When these ghost cities are being trashed, how much of this copper will be recycled? So I know there is a strong copper fan club around the world for good reasons. Good projects, you can always find them, and we haven't found many in the last 25 years, probably since the Mongolian Hugo Dammit success, and maybe later in the red bad copper in Central Africa. But overall, there are very few. So yes, on the supply side is concerning, but I'm not sure whether demand really represents such a pull, given the change in the global economic intensity of mineral use.
Yeah, I think I'll touch on the small modular reactor question. I think, overall, there are many forms of transforming the grid, and Canada's done a pretty good job of utilizing switching their grid to hydro, uranium, nuclear power, and gas. The US is kind of behind the scenes on that. Still a lot of coal plants. Gas is definitely a good second best option. I think since 2011, the US has built 4 large nuclear reactors, but the small modular reactors are definitely a great option for the base load. Our particular focus is not on uranium, but we definitely think it's a good source for the grid, the base load.
We only have a minute or two left. Any
sort of final closing thoughts to share?
I think the space itself is always evolving, and we're always, we have a finger on the pulse. We're often visiting mine sites ourselves. I was in Brazil in October seeing a rare earth project for lithium mines, and it's geopolitically changing every day. So definitely a lot to follow in the space. I'll pass it on to Thomas.
I think it's exactly right. point, we have to look at this space as one that's seeing a fracturing. And that's unusual for mining investors because mining investors really piggybacked on the Chinese development until about 4 years ago. So it's a new way of thinking about it, and we shouldn't get too concerned about deceleration in emerging markets because these phenomena and new technologies are global. They're not necessarily just related to huge buildup of infrastructure in a specific country, in one specific market, however big it may be.
Great. And with that, we'll wrap up today. We want to thank
Tomas and Stuart, our partners at Coherra, and of course our audience for engaging in all the great questions that you have. We'll make a copy of today's presentation available to download, and you can. Our final slide that was up just a few minutes ago had our contact information, so feel free to reach out, and if you want to learn more about what we're doing here at Amvest Terraden. We thank you again and hope to see you on the next one. Farewell.
Thank you.
Thank you.